a 40-year high inflation, skyrocketing prices of essential commodities, stagnant wages for workers, and a nasty housing market crash. This is the current state of the Canadian economy under Prime Minister Justin Trudeau, whose job ratings continue to wane even among previous supporters. But there are more economic woes on the horizon for residents of the Great White North. According to recent reports, the yield on the Canadian 10-year government bond has fallen about 50 basis points below the 2-year yield. The inverted yield curve is the biggest the Canadian economy has had in almost 3 decades. It is a harbinger of bad news for the economy, signaling more interest rate hikes from the Bank of Canada. According to market experts, the central bank may now have to raise interest rates to a level that triggers a recession, completely ending the narrative that there could be a soft landing for the economy in the fight against inflation. An inverted yield curve occurs when longer-term yields fall faster than short-term yields. According to analysts, it is one of the key indicators of a recession. But the Canadian economy is in no shape to handle a prolonged period of economic downturn or more interest rate hikes. Due to the scurry to participate in the red-hot housing market during the pandemic, many Canadians have become heavily indebted and unable to bear the additional burden of more hikes, which may affect their loan repayments. Like many other central banks, the Bank of Canada erroneously maintained that inflation was transitory well into the fall of 2021. It did nothing to address the skyrocketing prices of goods and gradually slowed down the economy until March 2022, when consumer goods had increased by 5.7% year over year, more than double its 2% target. In its denial, it allowed the problem to fester for so long that experts believe controlling it now will come at a bigger cost to the economy. 5 months and 4 interest rate hikes later, Canada's annual inflation rate remains high at 8.1%. The Bank of Canada continues to maintain that it will be able to cool prices without triggering an economic downturn. But analysts and experts believe that ship sailed a long time ago. Welcome to today's video on Savvy Economists. Please watch, like, and share this video as we bring you another important update on the Canadian economy. If you have any comments and observations, please drop them in the comment section and subscribe to the channel. Thanks, and enjoy the video. The Canadian economy is facing unprecedented times with record high prices that are crippling businesses and sending more families to the food banks. There has also been a big reversal in prices in the housing market. Since the February peak, the value of properties has dropped around 20%. With the rising interest rates, homeowners with floating mortgages now have to cough up more money for their monthly loan repayments. Every day, it becomes clearer that the Bank of Canada's promise of a soft landing, in which the economy slows but does not tip into recession, will be highly improbable. According to Derek Holt, a Scotiabank executive, a soft landing is not possible for the economy because the central bank will not ease up on rate hikes to stop a recession if inflation persists. Over the past 4 months, the Bank of Canada has raised its benchmark lending rate by 225 basis points to 2.5%. This includes July's 100 basis point hike, the largest increase since August 19, 1998. Though the easing of inflation in the United States briefly reduced the tension in the markets, it is still expected that the Bank of Canada's policy rate will rise to a peak of 3.5% in the coming months. That's higher than the central bank's 2 to 3% neutral setting and would definitely put more strain on Canada's already strained economy. While all sectors will feel the pinch of an economic downturn, the effects would go deeper in the housing market, which has slowed significantly since its February peak. Many reports show that Canadians are concerned that the interest rate hikes will negatively impact their finances. Both existing homeowners and prospective buyers are showing growing levels of anxiety amid the rising rate environment. According to the quarterly MNP Consumer Debt Index, 55% of Canadians were concerned about the possible impact of higher rates on their finances before the Bank of Canada started raising rates in March. By July, months after the first hike, around 60% of Canadians were already feeling the impact of the hikes, with a significant number saying they would be in debt if there were further hikes. More and more Canadians are worried about the state of the economy and confused about how the increases would affect their finances, another June survey found. Amidst all the uncertainties and confusion, the Bank of Canada is expected to announce another sizable increase on September 7th, increasing worries about the trigger rate coming into play for many borrowers. The trigger rate is the point at which a fixed monthly payment on a variable rate increases as the lender's prime rate increases in line with the central bank's rate. This means affected homeowners, already battling increasing prices of food, energy, utility and low wages, may have to cough up more money to fulfill their debts. According to market experts, many Canadians could hit that point soon. Elam Weintraub, the co-founder and director of Mortgage Outlet, recently warned Canadians to brace for more interest rate hikes. He said, "I actually think that the Bank of Canada is going to keep raising rates for a while until they really quash inflation. Imagine there is a forest fire, and you bring all this water and end the fire, but there's still a tiny little place that's got some burning embers of fire. That tiny fire could reignite the entire forest, so you want to keep going until the entire forest is flooded. I feel the same way with rates and inflation. I think rates are going to go up easily another 1.5%, and then 12 months later, they might plateau." The Canadian economy, much like the rest of the world, does seem to be spinning wildly out of control. But average Canadians bear the huge burden as policymakers try to put out the forest fire without creating a flood that could very well take down the whole economy. Every day, the hope of this happening grows dimmer, and Canadians can only wait for the final death blow. What do you think about the current dilemma of the Bank of Canada? Do you think it can successfully slow down the economy without causing a prolonged recession? Please drop your comments and observations in the comment section below. Also, ensure you hit the like button, subscribe to the channel, and turn on post notifications for more important updates on the world's economies. Thanks for watching.